Welcome to the Stock Market Palantir channel. Don't miss any new stock insights from us by subscribing to our channel and drop any comments below. Okay, let's get started.
All right, we have to start with the tape. We just have to. Because what we witnessed in the last 48 hours, that wasn't just a sell-off. It was a full-on capitulation. Doximity released their fiscal third quarter results on, February 5th. And the market treated it like a crime scene. I mean, we are looking at a stock that closed at $35.25 on February 4th, only to just gap down and collapse to roughly $23.69 in the pre-market on the 6th.
I'm going to jump in right there because capitulation is exactly the right word. Let's just look at the volume because that tells the real story, the panic. On February 5th, we saw, get this, 9.77 million shares trade hands. Now, for context, the 90-day average volume is only about 2.3 million. So that is, a 4 standard deviation event. That isn't retail investors hitting the sell button. That is institutional liquidation. The stock's hovering in the $33 range now, but the technical damage is, it's severe. We've triggered a death cross. The price is now violently below both the 50-day moving average of 43.52 and the 200-day of 57.09. The market cap just contracted to $6.27 billion in the blink of an eye.
The volatility is undeniable. And yeah, it's ugly. But I look at that same chart and I see a relative strength index, the RSI, that is just screaming oversold. I mean, we are at levels of pessimism that usually mark a bottom, not a top. And if you strip away the price action and just look at the actual business, Doximity just reported Q3 revenue of $185.1 million. That's up 10% year over year. They beat analyst estimates, and the profitability, an adjusted EBITDA margin of 60.2%. 60.2. I mean, there are incredibly few SaaS companies on the planet that keep 60 cents of profit on every dollar of revenue.
Okay. Profitability is great, but the market trades on the future, not the past. The reason the stock was absolutely decimated isn't because of what they did in Q3. It's because of what they said about Q4. They guided for revenue of 143 to 144 million. That implies year-over-year growth of just 4%. Just 4. The street was expecting 151 million. So when a company that's priced like a high-growth tech stock suddenly tells you they're growing at 4%, which is basically utility company speed, that is a thesis violation. You don't pay a premium multiple for single-digit growth.
And that frames the central question we need to answer today, right? Is Doximity a fallen angel, a monopoly asset that's momentarily depressed because of let's call it a political scare? Or is this the beginning of a permanent decline for a business that is simply run out of doctors to sign up?
Well, I'm taking the position that the growth story is broken. That 4% guidance is not a blip, it is the new reality. You have 85% of all U.S. physicians already on the platform. You've hit a hard saturation ceiling. You can't grow by adding users anymore because, you already have them all. On top of that, net revenue retention, the NRR, has slipped from 117% down to 112%. That means the customers they do have are spending less incrementally. And the macro environment? I mean, we aren't talking about a rainy day. We're talking about a hurricane.
You're referring to the regulatory landscape, of course.
I am. We have to talk about the Most Favored Nation policy, or MFN, that the second Trump administration has resurrected. This is the single biggest, it's the only risk factor that matters right now.
Okay, so let's break that down because it can get a little technical for people.
Sure. So Doximity makes 80% of its money from marketing solutions. Basically, Big Pharma pays Doximity to show ads to doctors. The MFN policy, it aligns Medicare drug prices with the lowest prices paid by other nations, like Japan or the UK. As of early 2026, 16 of the top 20 pharmaceutical giants, companies like AbbVie, Amgen, Merck, they've all been forced into these pricing deals. These companies are Doximity's biggest clients. And because they don't know what their profit margins will be on their blockbuster drugs for the rest of 2026, they've just frozen their marketing budgets. They are in complete budget paralysis.
That's an accurate description of the mechanism, but I interpret the outcome differently. Paralysis implies a temporary state. Pharma isn't going out of business. They're freezing budgets because they are uncertain, not because they are exiting the market altogether. They still have to sell drugs.
But there's a structural change coming that might mean they don't have to sell drugs the same way. Have you looked at the TrumpRx.gov proposal?
The direct-to-patient platform?
Exactly. The administration is proposing a government-run portal where the government acts as the direct buyer and seller of drugs to patients at those MFN prices. If that happens, the entire commercial model of the pharmaceutical industry it breaks. Historically, pharma pays doximity to influence a doctor to write a script for brand X. But if the government standardizes a formulary and the doctor has no choice in what gets dispensed, why would pharma pay doximity millions of dollars to advertise to that doctor? If the decision-making power is removed from the physician, the value of the doximity platform goes to zero.
Okay, wow. So that's the ultimate bear case, almost a doomsday scenario. But let me offer the counter-narrative. The pharmaceutical industry thrives on innovation. Look at Bristol Myers Squibb's launch of Cobenfy for schizophrenia. That's a new mechanism of action. They must educate physicians about it to get adoption. You can't just launch a new drug in silence. Now, if budgets are tighter because of MFN, are they going to spend money on Super Bowl ads where 99.9% of the viewers aren't doctors? No. They're going to need high ROI, precision marketing. Doximity allows them to target just the psychiatrists relevant to Cobenfy. In a budget-constrained environment, money flees inefficiency and it flocks to efficiency. Doximity is the most efficient channel in healthcare.
Efficiency matters, but only if the checkbook is open. And right now, it's closed. The analyst community sees this clearly. Piper Sandler slashed their price target to $40. Morgan Stanley cut theirs to $49. I mean, the consensus is that this wait-and-see period could last for multiple quarters.
Oh, come on. Analysts are reactive. They cut targets after the price drops to protect their reputation. But let's look at the valuation, because that is where the opportunity is. You can't just group doximity with distressed assets because the stock chart looks bad. Compare them to Veeva Systems, VEEV. Veeva trades at 36.5 times forward earnings. Doximity, after this crash, is trading at around 25.9 times forward earnings. You are getting a highly profitable monopoly at a massive discount to its closest peer.
That comparison is, I think it's flawed. Veeva is infrastructure. They run the clinical trials data, the R&D, the CRM. They are embedded in the operations of a pharma company. Doximity is discretionary ad spend. It's the first thing to get cut. I think a better comparison is Waystar, WASTAR. They're also in the healthcare workflow space. Waystar trades at 5 times sales and is growing at 15%. Doximity is trading at 10.6 times sales, so double the valuation, but only growing at 4%. Even after the crash, Doximity is expensive relative to its growth rate.
But you're comparing a low-margin business to a high-margin one. Doximity's 60% EBITDA margin warrants a premium. But okay, let's make this practical for the listener. Let's do the $5,000 challenge. If someone listening right now takes $5,000 and buys DOCS at roughly $33 a share, what happens to that money?
I'll take the short-term view. I think you are catching a falling knife. We have seen 27 instances in the last year where this stock moved more than 5% in a single day. The volatility it's extreme. If the MFN policy tightens, or if we get one more headline about Trump RX, this stock retests the 20s. Your $5,000 could become $3,500 in a matter of weeks. The risk profile is skewed heavily to the downside right now.
I disagree on the midterm outlook. If you have a 12 to 18-month horizon, that $5,000 looks very safe. And the reason is the buyback. Doximity executed $196.8 million in buybacks in Q3 alone. They have a $500 million authorization. That is a massive floor under the stock. The company is sitting on nearly $750 million in cash. They are telling you, we will buy our own shares if you won't. That reduces the share count and it props up EPS.
Buybacks are financial engineering. They don't fix the business. Long term, my worry for that $5,000 investment is the value trap scenario. If growth stays at 4 or 5%, the market will not pay 26 times earnings. It will pay 15 times earnings. That's multiple contraction. So even if revenue holds steady, the stock price drops because the market decides it's a boring utility, not a tech stock.
Or the AI pivot works. That is the long-term bull case for that $5,000. If DocsWe transitions from being a marketing board to being the physician's operating system powered by AI, the stock re-rates. If they successfully monetize these new tools, they go back to being a growth stock. In that scenario, your $5,000 could double.
Well, let's talk about that AI pivot, because you call it a revolution, but I look at the financials and I see a cost center. For the first time, Doximity's gross margins dropped from 93% to 91%. And that is directly because of the computing costs required to run these AI models. They're spending millions on GPUs to build tools that they aren't even charging for yet.
You have to build the highway before you can charge the toll. The adoption is real. 300,000 unique prescribers use their AI tools in Q3. Active users are querying DocsGPT 4 times a week. Over 100 health systems have bought the enterprise suite. This isn't just hype. Doctors are using this to write insurance appeal letters, summarize patient charts, and handle the administrative drudgery that causes burnout. It makes the platform incredibly sticky.
Stickiness is good, but usage isn't revenue, and there is a massive risk here. Clinical error. The CEO, Jeffrey Tangi, was very honest on the call, maybe a little too honest. He warned that AI models can cause clinical harm and that errors are difficult to spot. Doximity is moving from low-risk advertising to high-risk clinical workflow. One lawsuit, one AI hallucination that hurts a patient, and that trust, it just evaporates.
That's exactly why they launched the Peer Check program, where medical experts review the outputs. They're being cautious, but the utility is undeniable. If you save a doctor 2 hours of paperwork a day, they will never leave your platform.
Trust is the currency here. And, speaking of trust, we have to look at the people running the show. There is a trust deficit with this management team.
You're bringing up the insider trading news?
I have to. In January 2026, Paul Jorgensen, the former chief revenue officer, pleaded guilty to insider trading. He was trading ahead of earnings calls. That is a massive red flag for institutional investors. It suggests a lack of internal controls. When the guy responsible for the revenue numbers is cooking his own books, how can I trust the guidance?
To be fair, he is a former executive, he's been removed, and the company cooperated with the DOJ. You can't really indict the whole organization for one bad actor.
Okay, then let's look at the current actors. If this stock is such a generational buy at $33, why are the insiders selling? Director Kira Schur-Wampler sold shares in January and February. CFO Anna Bryson was selling before her leave. CEO Jeffrey Tangi sold huge blocks of shares in 2025 with over 470,000 shares. Actions speak louder than words. They're authorizing buybacks with shareholder money, but they are taking their own personal chips off the table.
I view the buyback as the ultimate insider buy. They spent nearly $200 million of corporate cash in 1 quarter to buy stock. That shows confidence. And regarding the institutional investors, it's a battleground. Yes, the Barron Healthcare Fund exited, and that stings, but look at Lorda Bet & Company. They increased their stake by over 114%. The smart money is divided. Some see a dying growth story, others see a deep value play.
The smart money is divided because the visibility is zero.
So let's wrap this up. How do we synthesize this for everyone listening?
I'll summarize my view like this. Doximity is a high-quality company trapped in a hostile environment. You have 85% saturation, meaning user growth is capped. You have the most aggressive regulatory pricing pressure in history with MFN, which freezes your primary customers' budgets. And you have a shift to 4% growth. To me, this is a show-me story. Until pharma budgets unlock and that growth rate takes back up to double digits, this stock is dead money or a value trap.
And I see the risks, but I believe the market has overreacted to a political cycle. Doximity remains the dominant digital platform for U.S. physicians. They have elite margins, 60% EBITDA, and a fortress balance sheet with zero debt. The AI pivot is real, it's growing fast, and it solves the #1 problem in healthcare, physician burnout. So I think investors with a long-term horizon are getting a premium asset at a crisis price. The panic selling has created an entry point.
The next few quarters will depend entirely on whether that budget paralysis is a temporary freeze or if it's the new normal under this administration.
Precisely. If the budgets unlock, the stock rebounds. If they don't, the valuation has to reset. We'll leave it to you to decide if that risk profile fits your portfolio.
Thanks for listening.
See you next time.
If you like this video and want to watch more content like this, then hit the subscribe button. It's totally free. Thanks for watching and see you in the next video.